Good afternoon, everyone. Thank you so much for taking the time out to have a listen to our webinar series. Just to give you a bit of background as to why we set this up, I think it's so important to have a look at the substance behind everything. So Alfonso and myself have had many conversations with different people where all these types of questions that we'll go through in the next 6 weeks are actually asked to us in various different ways. The importance of all of this is often people are looking at things from an investor's point of view, or when you're speaking to an advisor from an advisor's point of view. And I think it's so important to give perspective on each of the sides of the coin, so everyone can understand exactly what's happening. And going through this whole Building a Legacy webinar series that we've put together will give everyone a bit of an understanding as to why people make decisions the way they do, why due diligence needs to be followed, and why it's so important to make the right decision first off instead of having to go back and try and change decisions that have already been made. So to start everything off, I think it's very important, and we are very grateful to have Rob Enslin on the call from Strategiq Capital, looking at how do we actually go and find growth opportunities and diversification in the market that we're in today. And it's an extremely important thing to ask, because the rest of the webinar talking about industry fees, talking about Forex, talking about protecting your assets, jurisdictions-wise, succession planning, tax efficiencies. None of that actually matters if you can't go and find the type of returns that you're looking for. There's no point in minimizing your capital gains tax liability if you're in a loss, if that makes sense. So to start off, I think it's an incredibly important conversation to have, both locally and offshore. And I think Rob will touch on many of those things. And I'd just like to thank you for joining us. Thanks, Rob.
Thanks very much, Tom. Thanks, Alfonso. Looking forward to it.
Yes, thanks. We are also very happy to have you, Rob. I'm going to jump straight into it with the market talk. And something that a lot of people obviously talk about is timing the market. Obviously, there's a lot of upside and downside to getting the timing that you are in the market right. But obviously, there's a lot of things that you've got to look out for. I know this is a conversation that you've probably had many times. What's your opinion on it?
Yeah, I think obviously what people often tend to do is they'll look at a graph and assume, well, if I sold here and I bought here and I got all of these things right, my returns would be so much better. But the reality is that I don't think there's really anyone who has that skill set to be able to time the market. I think what often tends to happen, and we've really tried to share extensively during this period, is that markets often tend to behave or perform in the least expected times, and returns can often be quite lumpy. So by way of example, if one takes a look at the S&P 500 over the last 25 years or so, really the difference between missing the best 40 days is gigantic for clients. So just by way of example, over the last 25 years, the S&P 500 has returned roughly around 8.5% over that period. As an investor, if you were trying to time the market and incorrectly got that timing wrong and missed the best 40 days of those 25 years, that 8.5% annualized return is completely wiped out to around zero. So that's the first sort of point to make. And then I think very importantly, coupled with that is, of those 40 best days, around 80% of them have actually tended to happen in the least expected time, i.e. during bad times. So like the dot-com bubble, the great financial crisis, and even now during COVID-19. So it's sometimes a little counterintuitive, but to circumvent that or almost ensure that your probability of return is better, we suggest to clients stay invested, don't try and time the markets.
Okay, well, that makes a lot of sense. To kind of just stay the course on that end, even if things aren't going well, that's often when you see the returns coming back. So that makes a lot of sense. Something that I've always wondered about now during these times, I think we've seen it a lot, is that bonds and equities tend to move in that, well, they don't tend to move in opposite directions anymore. How does that work?
Yeah, so maybe just provide a little bit of context before I answer it. So typically speaking, when you construct a multi-asset portfolio, the bond segment of the portfolio is often used as a shock absorber, if I use the word, to offset the drawdowns in equity markets. Just to understand that, the way a bond prices, as yields come down, there's actually a capital appreciation event, and hence that shock absorber dynamic. What we've witnessed during COVID-19, which really the sell-off happened in March, was that there was almost like a correlation to one, meaning that all assets kind of fell, and indiscriminately we were talking about equities or bonds. But I think there's a layer below that we do need to understand. So if one looks at bonds, you've really got three broad segments of bonds. You've got bonds that are sovereign or government type bonds that don't carry credit risk. And then you have investment grade credits, which is obviously highly rated credit. And then a layer more speculative above that is high yielding debt. And within that bunch, the sovereign or the government bonds actually did perform well. They did do their job. What happened was the credit, because people worried and there was a panic in the system, the amount of credit that investors were requiring to buy this bond shot out. So credit spreads almost shot out. And as a result, it offset those tendencies that we spoke about. Since then, the market has settled down a little bit, and the yields, the credit spreads over and above the sovereigns have come back a little bit. And as a result, the traditional sort of dynamics of bonds are starting to sort of play out a little bit relative to equities. The challenging part about bonds at the moment is that interest rates have been cut, or bond yields have been pushed so far down that there is very little left in terms of that shock absorber in sovereign bonds. And therefore, investors are now tending to look towards that credit spread to offset that risk in portfolios.
That's very interesting.
Answers it to some degree, yeah.
No, definitely. I think as a lot of people are trying to create these portfolios are starting to see that everything's just correlated at this point, which is quite a struggle.
Yeah.
One of the big winners that we've seen in the past 36 odd months has been gold. And I mean,
yes.
naturally now it makes sense that because it's a safe haven asset that it's obviously gained a lot of traction. But why have we seen such a good, strong run even before COVID-19 on gold?
Yes, so I mean, if we think about gold, it's actually been around for thousands of years firstly as a means of exchange, i.e. a way to transact, and then a store of wealth. But one of the big disadvantages of gold is that it doesn't pay a cash flow. Like when I talk about a cash flow, something like a dividend. So there's a big opportunity cost as an owner of gold, whilst other asset classes are paying some form of cash flow, whether dividend or coupon, etc. And that opportunity cost is, the greater the opportunity cost, the bigger the relative compared to other asset classes. What we've seen over the last couple of months in particular, through stimulus packages from central banks and governments, yields have been suppressed all the way down to zero, in some countries below zero. So that opportunity cost is reduced, and therefore that trading gold has made it a lot more attractive. And I think that's primarily the reason why we've seen a run in the gold. But then also importantly to understand is, if you think of a government as a company, they've all gone and stretched their balance sheets significantly. So there is certainly a lot more risk in the system and the threat of inflation in years to come. And gold, that second point I made, as a store of wealth, plays an important role from that psyche perspective. And I think those two factors together are contributing to the run that we've seen in gold over the last couple of months.
Yeah, that's actually something that a lot of people probably overlook with regards to that, just thinking of it as a safe haven asset without actually delving any deeper. Absolutely. To touch on gold, obviously the history of gold moving into fiat currency and all of that.
Yeah.
With what we've seen in the markets and what we've seen from governments and stimulus packages and so on, they talk about the money printer and how much money's been actually pumped into the system. Do you think this is giving a bit of loss of faith from individuals in the fiat currencies, and maybe this might be the start of a movement towards digital currencies or Bitcoin or whatever it might be in the future? Do you think that's something that we can actually keep a lookout on?
Yes, I think it's always an interesting question, the Bitcoin debate, and I think our side of the industry has always been trying to dispel it or talk against it. I'm certainly not going to dispel cryptocurrencies per se. I think certainly that type of technology is here to stay. It's been implemented in various banking models and in various forms, and you're even hearing central banks like the English and even the US central banks talking about implementing a digital type currency. I do think, however, what we have seen over the last period is very similar to that, the talk about that retail investor, that stay-at-home individual in the 20s and 30s who hasn't been going to work and has suddenly taken up a trading account. And the natural derivative of that is to look at the cryptocurrencies, and I think that has been an input into the demand of it. I don't think the likes of Bitcoin are quite there yet to replace traditional fiat currencies. if you think about it as a means of exchange, we're not quite there in the ability to go and put a deposit down on a house with your Bitcoin, or walk into your grocer and use Bitcoin freely to purchase your goods. So the liquidity aspect of the likes of Bitcoin and other cryptocurrencies isn't there. But what, as a sideline comment to make, is what we've certainly been watching and have seen is that cryptocurrencies like Bitcoin do hold some negative correlation attributes, and could very well in years to come see it as an alternative asset class alongside bonds, equities, cash, gold, etc. They have behaved quite differently and defensively during this period.
Sure, that's quite interesting.
In short, I don't think we're there yet to replace currencies.
How long, Rob? How long before we're there?
That's an answer I'm not going to even try and put out here.
Surely looking forward to that day. I mean, it's been on everyone's lips, I think, the whole year, even last year, and in between everything that's happened with the coronavirus, I think we've forgotten about it a little bit. But I mean, the trade war at the moment still going on between US and China. If that continues as it is at the moment and even worsens, what kind of aftermath does that give to the markets, firstly, and to different economies such as ours?
Absolutely. So for me, that's a very important debate that we're having as an investment team at the moment. COVID-19 is certainly a big risk, but if anything, it's in the price now. We're aware of it. We've always said a shock happens when it's a sideline swipe that no one has really taken account of. Today, COVID-19 is certainly a risk, but it's a known risk. The trade tension escalation for me is a little bit more uncertain. I really break down that answer into 2 points, and it almost, the US elections ties into the whole trade war tensions that we're witnessing. So as it stands right now, or maybe take a step back, walking into 2020, it looked like a foregone conclusion that President Trump would stand for a second term. He did peg himself as alongside the US stock markets as well as the economy, that at that point in time in January, we were both at record highs. Since then, a lot has happened, and certainly President Trump has lost a lot of credibility. As the polls stand right now, it looks as though the Democrats may very well win the elections. Now, the Democrats' agenda and the Republicans' agenda are very different. If we look at the voter base within the Republicans, Donald Trump holds a much higher percentage of Republicans that support him. Whereas if you look at the Democrats' vote base, it's a little bit more about the party's policies and less about the candidates. So as a result, I think President Trump is going to try and push his agenda really hard. And his agenda has been very pro-America, making America great, fighting back against the Chinese. So if anything, that's the type of sort of election campaign that he's likely to run. And if he does end up winning, I think he needs to then follow through on what he has promised his voter base. So what does that mean for stock markets? I think the Republicans are very pro-America, keeping taxes low, and all else equal, I think it would be net positive for the US markets, negative for emerging markets, because the trade war rhetoric, that uncertainty would be back on the cards. If the Democrats were to win, they've made it clear that they're likely to hike company tax rates by around 7%. So if anything, that would be net negative for the US. And I would think they would probably try and patch up some of the broken relationships that have been created over the previous administration. And as a result, you could very well see a positive for emerging markets. So Democrats, positive for emerging markets, including South Africa. Republicans, I think the status quo holds as we've seen over the last 4 years.
Okay, so basically everything's still very much up in the air on that side.
Yeah, I mean, I think it really comes down to how Americans vote.
Yeah. Okay, well, that's interesting. And you say, obviously, from a South African perspective, if Donald Trump, for instance, stay, then we'd probably be worse off.
Yeah, I mean, it's quite a loaded question. I think there's some other points also just to be aware of. So part of quantitative easing and COVID-19 relief that we've seen from the US is that they've created around 25% more dollars in the financial system now. So all else equal, more supply of dollars should see a weakening of the dollar, and we have seen a bit of that in recent weeks. The weakening of the dollar has traditionally been a nice underpin for emerging markets. That, coupled with relatively better valuations in emerging markets, All of those sort of factors together, maybe a little bit more friendly environment, assuming the Democrats win, all points to potentially a better decade for emerging markets compared to what we've just gone through.
Definitely.
There's a lot of ifs and things that have to fall in place for that to happen.
Yeah, no, it's obviously there's a lot of factors that plays a role. From a local point of view, I know a lot of people are very worried about prescribed assets, especially looking at pension funds and so on. What's your thoughts on that? Do you reckon that that's going to happen, and what would the impact be?
So I think before I answer the question, just important point to make is that prescribed assets are not new to South Africa. They were passed through the Pension Funds Act during the apartheid era, sort of peaking in the late 70s. At one point in time, prescribed assets had to make up around 77% of your pension fund, essentially, towards state-owned type companies like Sasol, etc. So for us, it's not a new dynamic, certainly been used in the past. What's probably a lot more concerning for us is what assets we'll be forced to buy should it be implemented from a prescribed asset perspective. And just given the track record of the ANC over the last 25 years, it would be questionable whether we'd be wanting to put your hard-earned savings into some of the state-owned enterprises, given their track record to date. But I think the point is prescribed assets will be all else equal negative. It's not a good thing. People want certainty, and that's just forcing them to invest in a certain way. But I must caveat that with the point that the official stance of the Treasury at the moment is to not implement prescribed assets. We know we live in a very fluid political environment, and that could change overnight. But the official stance right now, I think they understand that that would be negative towards the sort of SA Inc. investment opportunity if they started to implement prescribed assets.
I think we should record the dates on this to see how everything pans out from that point forward.
Yeah,
maybe you can use
we live in a very fluid environment.
Perfect way to cover yourself there. Rob, from an asset management point of view, is it just becoming harder and harder to analyze and predict market movements? I know it's never been possible to predict. No one's got the crystal ball in front of them, but especially with all the stimulus packages and the monetary policies, the money printers I mentioned earlier, is it just becoming near impossible to predict it? Has it just become an asset allocation discussion?
Yeah, so on the one hand, I think I talk about the last decade post the financial crisis, almost the dominating force has been the macro call, getting the macro call right, and understanding what inflation is likely to look like, what growth, what stimulus means for asset prices, has been a far more important decision to get right than the bottom-up stock picking perspective. And to that point, I think growth type business models have certainly outperformed value type stocks over the last decade. But I don't think that under bottom-up research and stock picking is dead, by no means. I think if anything, this period during COVID-19 has dispelled that view that active managers are dead. I think active managers have outperformed many passive strategies. I think markets go through periods of inefficiency and not. And if anything, we are certainly in an environment now where the ability to forecast what the next 3 years looks like is really hard. So in that lies an opportunity for active managers. From our standpoint, I think both have a role to play in portfolio constructions. And as and when the environment plays out, the contribution to each plays a different role.
That's very interesting because I mean, fund managers like Fundsmith per se are clearly they have the bottom-up approach on their side, and it's obviously done very well. But when you look at other fund managers who've tried the same thing, it's a very different discussion, of course. Rob, going back to, I mean, we've done a few of these things between the three of us. One of the things that we asked you previously was, what are your predictions on the interest rate drops? And you were actually spot on with how many times and what has actually transpired from that point of view. And again, I think it's probably important to track the data and then ask you, do you predict any future drops this year? What are your thoughts on that?
Yeah, so South African Reserve Bank follows a mandate. Their primary objective is to ensure price stability. And I think this is always this question. People say, cut interest rates to stimulate growth. And the answer always, the subtle answer from their side is always, our primary objective is to ensure price stability. Once we have price stability, then we can look at the other notions like growth, employment, etc. Now, with that price stability, they've set price targets. So they don't really, or inflation targets. So from their perspective, the inflation target is between 6 and 3%. When inflation dips below 3%, they cut interest rates, and when it's above 6%, they hike, in simple terms. What we've witnessed over the last period is that they've cut interest rates, or the repo rate, down to 3.5%. It's the lowest the repo rate has been in 64 years. So money is cheap at the moment. So structurally, there isn't much room to cut much further. If you think about it, at 3%, once they get priced into that 3% range, there's no real yield from their point of view. And they certainly don't want to have an environment with no real yield. They want to keep a little bit of a real yield buffer. So structurally below 3%, I don't see it. We're at 3.5 now. Temporarily, our expectation is they may cut another 25 basis points. But I think really what I'm saying is there's no more big cuts in the horizon. And I think they would prefer to almost be a little bit more gradual and avoid having to then hike in 2021, 2022 as prices start rising again. So short and sweet, probably 25 basis points if you maybe make a call.
Okay, we'll check and then hold you to it. Hopefully you spot on again. Obviously they've been dropping the interest rates constantly over the last while. If that tends to continue happening, what would the economical impact be more longer term from a South African perspective?
Yeah, so I'm going to answer that question in a way globally as well, because it has been a global phenomenon to cut interest rates lower, and it hasn't only happened now. I mean, to be fair, interest rates, money has become cheaper for the last 30 years on a global scale. Then the traditional, the answer that we were all taught at university was ultimately you create inflation because you're creating demand today for future inflation. However, that's what the textbooks say. I think what history has taught us and what the real economy has taught us is that we sometimes underestimate human and technological intervention. So if we cast our minds back to the turn of the century, we actually lived in quite a similar environment. We had the Spanish flu, and part of the Spanish flu forced people to innovate. Back then, innovation was automation or manufacturing in that regard. And all that it actually ended up doing was increase our capacity output as society, and it made goods that used to be historically very expensive to produce a lot cheaper. And the effect of that was that the middle class were all of a sudden able to access products that previously were only being able to access by the rich. And partly led to the Roaring Twenties. The Roaring Twenties was a period in civilization where wealth was probably at its highest on an averaged basis. So if you think about what's just happened now, we've gone through a COVID-19 crisis, we've made money cheap, but a part of that has also been that we have been forced to accelerate innovation through technology. So the caveat to the inflation standard argument that everyone gives is that we could very well see that because technology is deflationary by design, that inflation that we all predict is going to happen doesn't happen. And we actually move into quite a productive period. If you think about companies, how much money we've had, by a simple example, how much money we've had to spend on rent to occupy big buildings. You remove that rental line item from your income statement, and all of a sudden you've injected a new level of profitability. So just playing devil's advocate, things may not play out as we all predict, but the standard answer would be inflation in years to come.
Sure, I find that very interesting, looking back and so on. Obviously, with all the volatility happening at the moment, where do you go look for the right opportunities? How do you guys formulate a strategy to find those opportunities? Yeah. Obviously, you do a lot of research that takes time, but yeah, where do you find those opportunities?
Yeah, I think the reality is none of us have a crystal ball. We don't have a special crystal ball in our office that we rub a bit harder in times like this. I think we rely very much on that strategic asset allocation core. It has sort of stood the test of time. And as a result, we spend a lot of time understanding what our strategic asset allocation looks like, understanding what risk-adjusted return the various asset classes that make that strategic asset allocation look like, and then tactically make small tilts around that just to manage that risk. But certainly we don't believe that this is the type of environment to try and outsmart markets per se. And And our guiding light has been that view. And then once we have that view, we continue to favor high quality growth type business models or managers who tend to have that type of psyche. On a risk adjusted basis that makes sense to our belief towards markets.
I think that's very in line with what the companies will start moving towards, especially in times like these, because we've seen certain South African big name brands, I'm not going to name them, be extremely hard hit by these crises, because I personally think they're trying to outsmart the markets, as you say. So from that macroeconomic point of view, we can look at things and say, look, we are probably going to go into a recession before COVID. We know we're in a recession and we're going to go quite deeply into it. The question is, at this point in time, how deep a recession will this actually be for South Africa? And what type of impact does that have on firstly the JSE and then the investors investing in the JSE? What type of impact does that have?
Yeah, look, I think when you go through these massive sell-offs, these once in a sort of a generation type sell-offs or events in markets, it's very hard to pinpoint economic expectations. So if anything, we're not trying to work out what the perfect number is. Guidance is generally around 7 to 9% recession that we're likely to see for the full year, and we would go with that type of thinking. For us, what's probably more important is to understand what segments of the market are likely to respond and come out of the recession a lot faster, and what segments of the market are going to be damaged for a longer period of time. Also very important just to point out is that if you look at the All Share Index, there's actually quite a big disconnect between our local stock market, if the All Shares to go by, and the real economy, because around 60% of earnings of the All Share Index are derived globally. So there can be this very big disconnect where we become overly focused with what's happening domestically, and ultimately it's actually more the global drivers that are pushing our local stock market at the moment. So that's really a little bit more where our focus is at for now. And if you had to ask me where I think some of the real pain in South Africa is at the moment, I think a big part of this has been a structural loss in jobs. South African economy isn't necessarily designed like the US that we switch jobs on and off as quickly. And as a result, many people who have lost their jobs in this economy will unfortunately find it very hard to find new employment. And a large part of that would typically be your general retailers, your clothing retail type stocks. They certainly, from a bottom-up point of view, do look attractive and cheap. But we just need to understand what are going to be the drivers of purchasing of those goods. Is there going to be discretionary money in the system to purchase them? Certainly, interest rates with being cut to the levels that they have does help. But then there's another layer of understanding who's buying on credit and who are cash buyers. So it's that sort of level of thinking that we go into when we're identifying stocks.
That's very interesting. So last two questions, they might be the same answer, but let's just go into this. As an asset manager, are you looking more towards, in the long run, South African-based equities or offshore-based equities?
So I think if you look at the South African stock market, it's unfortunately over the last 10 years or so, it's actually become a lot smaller. If you take the top 5 biggest companies on the Johannesburg Stock Exchange, they represent around 49%, 50% of the entire market cap. So we've become a lot narrower. We're not seeing the same amount of new listings on the Johannesburg Stock Exchange. If anything, you've seen a lot of companies leave the Johannesburg Stock Exchange, go private. And then within that small cap segment or belly of the market, liquidity is light. So even for smaller portfolio managers to access that is quite difficult. So for those forces, I think you have to look globally. It's a much bigger world out there. There's a lot more opportunities than just a South African bias or home bias. And then also, if we take that type of thinking and understanding the level of innovation that's been taking place locally compared to some developed markets and even emerging markets, you'd argue that there are some new opportunities that you just aren't able to access on the Johannesburg Stock Exchange. So take the social media type businesses, the likes of Facebook. That is a business that is a mega cap global company now that probably, didn't exist in the previous economic cycle. We're unfortunately just not seeing that level of innovation from a South African perspective right now. So if you ask me where would I put my money for the next 20 years, I think unfortunately I would be attracted more to the global sphere of opportunities.
No, 100%. And I think that goes into my next question, and maybe more as a personal investor and not as a director of an asset management firm. If you will ask all of our panelists this question, so it'll be interesting to track these. But if you had R1 million surplus to your requirements right now, just sitting in your bank account, how would you go about investing it? Obviously, keeping in compliance with your compliance officers there.
Yeah. So I subscribe to a multi-asset approach. I think you've always got to build a portfolio that can weather various storms. And really that tilt in terms of aggression in the portfolio has to do with your ability and your willingness to take risks. So something like age, the amount of money you have is important. But with that sort of thinking in place, I would certainly look to a multi-asset strategy that focuses on offshore equities, and the offset would be made by local fixed income type assets. I think the local fixed income segment of our market is actually looking very attractive. If you look at, for example, longer dated bonds, like your 10-year government bonds, they're offering you a yield of give or take around 9%. Inflation at the moment on a normalized basis, although the last print was around 2, I'd see it more around 3. That's a very attractive real yield at the moment, and I think not one to be dismissed. So essentially, offshore equities offset with some local fixed income strategies for now would be how we would position, how I position my own money, and that's exactly what we are looking to do actually in our local multi-asset strategies for clients.
It's a very good answer. So thank you. I think that was the last question. Thank you everyone for joining us and listening in. As Tom mentioned in the beginning, we'll be doing this every week on a Thursday. So you're more than welcome to jump on. And thank you, Rob. Thank you for your time. I think a lot of us got a lot of insight there into different topics that is very pressing matters at this point in time. So thank you for your time. I'm sure we'll do another one very soon. And then, yeah, as I mentioned, next week we're doing one on industry fees, taking a look at different asset classes and what kind of fees consumed for that specific investment. Looking at property, from property to different investments, and what kind of you have to look out for when you're making an investment. So thank you very much once again, and we'll see you all next week. Cheers.
Thank you, gentlemen.